Right, everyone. Mics are working. Good. Investing in Troubled Times, Volume 2, en inglés this time. Luckily for you, Vlad, and probably for me as well. But yeah, thank you to Tech Spirit for putting this one on and for gathering such a great panel here. We've got 3 investors who've flown in from London today. Perspectives looking at the US, Asia, and also a good focus on Southern Europe. So loads to discuss. This is one of those topics that we've all heard a lot about recently. It's a topic on everyone's minds. How is the current macroeconomic climate affecting fundraising, affecting startups, founders, and investors? So we're aware that this is something that you've probably thought about a lot, so we're trying to keep it focused and focus on examples and solutions and positive stories to come out of this environment and lessons for entrepreneurs and founders today. So I'll just start off by asking everyone to do a quick intro from the furthest away. Jordi, tell us, who you are, where you're from, what you invest in.
Hi, hello everyone. So my name is Jordi. I'm from Barcelona. I was born here and I've been raised here. I've been for the last 10 years involved in tech as a consultant, as an entrepreneur, and for the last 6 years as an investor at KIBO Ventures. Super quick summary about KIBO. We are an early stage VC fund. We do Series A tickets from 2 to 6 million, sector agnostic, and that's it.
Yeah, and Virginia?
Hi everyone, my name is Virginia. I'm Italian, as you might hear from my accent as well. But I moved to the UK 5 years ago, so I'm based in London at the moment, and I started working at Eightroads a couple of years ago. Eightroads is a global VC or early growth tech fund. We invest in Series B, Series A company, so tickets from $10 to $30 million. We focus on Europe. We are sector agnostic, so invest from B2B software, consumer, fintech, health tech. We are 100 people globally, 15 investment professionals in London, and we have around 11 billion of assets under management today. And we have 5 investments in Spain.
Great. And Josep?
Hi, good morning. I'm Josep Santacana. I'm a partner at Korelya Capital. Korelya Capital is a growth fund with offices in Seoul, in London, and Paris. It's a late-stage fund with 3 different vehicles. The last one is a fund of 350 million. We're sector agnostic and investing predominantly in Europe.
Brilliant. And finally, you, Vlad?
Hi, everyone. My name is Vlad Tropko. I'm a partner of Digital Horizon. So we are a fintech and B2B software-focused VC fund based out of London. We have an office in Tel Aviv and Dubai. We love to invest into immigrants. We have more than 20 nationalities in our portfolio already. So we've done more than 30 deals through the last 5 years. That's basically it.
Brilliant. Okay, so as I said, I asked the investors that we've got today to bring some examples with them for us to kind of bounce some ideas around. And we'll start with you, Virginia. You gave me one example of a company that you were looking at that had adapted its sales strategy. And, I've heard this from investors when we ask, what's your advice for companies? And they say, if you're focused on venture-backed startups mainly who are struggling, maybe find some different customers, adapt your customer base. So tell us about your example, Virginia, of changing that dynamic of customer base.
Yeah. So we looked at the company in the current context, and I wanted to bring a positive example because I think sometimes crises can bring clarity to the ICP, so the customer target that you have in the go-to-market strategy as well. In the current market context, I think it's particularly important to adapt quickly and be able to prioritize. A practical example, we look at a company that was serving very small type of clients in the fintech sector. So companies from 10 to 100 employees. These are probably the companies that now are having more hard times compared to others. So they are maybe not willing to buy new products or test new things in the market. And they were able to realize that this was not working anymore, and this was the strategy that they had for the past 1 year, basically. And they said, okay, we have 2 weeks, let's try to change completely our approach. So they sit down also together with the board, together with advisor, and they try to understand who they could target in a different way. So their product is very flexible, so they could adapt their offering to different type of customers. So they decided to do in 2 to 4 weeks a trial with different set of customer, starting with a very large one. Initially, not great feedback, because typically when you switch from small customer to large customer, the sales cycle is much longer. But they decided to split their products in more part to sell to large corporation one part of the product first, let them test, and then take the time to upsell. And in the current market dynamic, I think that was very useful to see as an investor, because you can see, great, you had a problem, you found a solution, and in less than 3 months, they already had results, and very good results that an investor could assess. So that was a positive example for me on a company that was able to adapt very quickly.
Yeah, and Vlad, you gave an example as well of a company that you'd looked at investing in that had kind of also, it had a certain sales strategy or a certain client base in mind, but then had to adapt that. So tell us about that one.
Yeah, so the story was the following. The company was fintech focused on B2C, but because the cost of acquisition through digital channels was amazingly high, and in current environment you could not afford to have a negative unit economics, they decided to move into the B2B space and start to sell in their API product to the corporates. And because they build a quite good technology stake within the company, and luckily they have a quite good traction, but not enough to fundraise. What we're seeing right now, that the traction is still there. Even the sales cycle is much longer comparing to B2C products.
Yeah, so is this something that people need to, I guess, prepare for, that if they are having to move away from, I suppose, focusing on venture-backed smaller companies, that if you're aiming to go for these large enterprise clients, that you just have to bake in that longer time? Josep, I don't know if you've seen any companies in your portfolio sort of adapting their sales strategy.
Well, I guess on this blip, on this crisis, on this change of paradigm that we live in, all companies need to adapt. B2C companies more than others, but I think that no one is immune to a change of, as I said, a change of paradigm. And we as an investors, we need to do that, and we need to try to make sure that we help the companies, and we help the companies in transitioning, and ourselves as well, adjusting to different offerings and different ways of trying to help the companies. A lot of the things that we're trying to do now is clearly work with the founders, with all the parts of the company, to try to adapt, and of course to try to make them focused on what we think as experienced investors that have seen several cycles and several contexts of doing business, to try to adjust the entrepreneurs and the businesses to what we think is the best market fit. And the companies that are most reactive and quicker and more pragmatic on doing that, and certainly the companies that are going to come on top of that. And we as investors, we try to really be adaptive and as well forward-looking into whatever they need to do.
Yeah, and I suppose it's not just about adapting your strategy in terms of go-to-market and your client base, but you might also need to adapt the timing of how you do things, because, you know, the fundraising environment has changed. You might have been expecting to be able to raise easy 2021 style money at the drop of a hat like you did last year. So Jordi, tell us about the example you had of a company that had to change its strategy because of the fundraising cycle it was on.
Yes, so this is a company we invested back in 2021, beginning 2021, and the plan when we invested in this company was, to build things, start getting initial customers, etc., and to raise our seed, late seed, maybe pre-series A round around 2022. So we sat with the founder at the beginning of, well, it was more Q2 2022, and we saw that the funding environment was, as our colleagues before said, the bar is super high. You need to be very much focused on growing, but also having solid unit economics. And in this case, the unit economics were not there. So we decided, to stop investing in some kind of stuff like marketing until we could improve unit economics. We stopped investing in go-to-market channels that were bringing in customers whose lifetime value was not as good as we wanted. So basically, these guys had payback times of around 14, 16 months, and in that environment, we thought this is gonna be tough for investors, so we decided to close all the channels, the marketing channels, go-to-market strategies that could give us higher payback times, and went to customers and strategies that gave us or bring us customers with shorter payback times. And that basically what did was extend our runway, so this company is now growing, maybe not as fast as it was supposed before, but it's growing healthy, and the plan is to fundraise late 2023, beginning 2024, when we believe the market is going to be a bit more open to these kind of companies.
Yeah, and I suppose the timing is so important, right? And also the context of when you raised last. And Vlad, with your example, I think you said they were not so keen to take a down round. They'd had a very high valuation. So in that case that, let's say you got a very high valuation in 2021, just because that's where the market was at, I know it's tricky asking this to investors because you're going to say, yes, accept the low valuation, but what's your advice to people when considering those down round dynamics? Should they perhaps be looking at a convertible note or a different, other fundraising strategies like revenue-based financing? What's your advice without trying to screw the founders over too much?
So certainly, it really depends on the stage of the company. But if you're quite early, definitely during this year we see a growing number of convertible notes and safes on the market. If we're speaking about the growth stage, we're seeing more and more tricky terms in the term sheet. So like 2 times or 3 times even liquidation preference on a growth stage, because some founders, from the PR perspective, they don't want to show the down rounds. That's why they want to show the flat rounds in a press release. But under the hood, you will see some issuing warrants to decrease the price per share, effective price per share for the company. Some issue liquidation preference, which is higher than previously. So, and we see a lot of this in the market right now. But hopefully next year the market will stabilize, and more founders will be wishing to go and make some sort of down round. It's not a bad thing, by the way. So even DoorDash several years ago, 2 or 3 years pre-IPO, they have a down round. But after the IPO, they're remarkably good and then continue to grow.
Yeah, and the valuation is always something of a vanity metric, isn't it? Like Klarna, for instance, had its valuation slashed by 85%, but it's still worth $7 billion. So, it's not exactly a shameful thing, is it? So what are you guys seeing in terms of that, in terms of these deal-making dynamics and, the perhaps increased prevalence of convertible notes, and what do you think founders should be watching out for? Have you guys, any of you seen? Josep, yeah?
One of the things that is very clear, the relevance has always been very, very important. But sometimes at any stage, founders, and particularly when things are very bullish, when rounds take 5-10 days to close, and it's almost like you need to rush to put your foot on the door to the founder, convince them, hey, take my money, or almost back. There's a very precious asset that sometimes is not well taken care or taken care enough by the founders, and that's the cap table, right? And the cap table, there's an incredible asset for a founder, and in the times that we live right now, when you open the door, maybe there are not that many people that are running towards you, and probably a lot more running away from you. What is really important is to be able to talk to your board, talk to your cap table, and say, this is a transition time. Companies that you believe in that work very closely with investors. They can do internal rounds in form of convertible or equity rounds that they're not exposed to the volatility of the public markets that of course affect the private markets, but to work with your strong partners in the cap table and provide funding for the development of the business. That is the core and the most important part. And that's something that sometimes is ignored, and a lot of people accept money. But for us as an investor, it's not only important where we invest, but who we invest with to make sure that when everyone needs to chip in, it's not only you.
Yeah, so hopefully, I suppose in these moments, funds naturally will become a bit more focused on their portfolio companies and trying to help them get through. So your advice would be to really try and tap up your cap table and use them as much as you can when you've got those pre-existing relationships. When you do need to go to the market, let's just talk about how the deal dynamics have shifted and what founders here maybe should know about that. Because as we've kind of touched on how, back last year, you maybe got a term sheet and an investor would make a decision within 5 days. What is the how would we say that founders should be approaching the cycle in terms of their planning, the timeframes around the beginning of a conversation with an investor, and how long that might take today compared to, let's say, last year? Virginia?
My suggestion would probably be to plan as much in advance as possible. So companies should probably target to have always more than 9-12 months of runway. The more the better, clearly. But sometimes I get asked by founders, I have 11 months of runway, my burn is relatively high, what should I do? Should I raise? Because clearly no one wants to do a down round, neither current investor or startup in general. So plan in advance. And now rounds takes a bit more time compared to last year. It's no joke. As an investor, last year you were getting requests and maybe you had 7 or 10 days to take a decision and send a term sheet. But the reality is that due diligence as an investor takes time as well, because you need to understand the founder, you need to build the relationship, you need to understand the market, the business model. There is a lot of things to do. So the more time you dedicate to it, I think the better. So I would probably take at least between 3 and 6 months in the current market context to prepare to raise. And what we are seeing in terms of deal dynamics is are also both investor and founders getting slightly more creative. Yes, no one wants to do a down round, but there are some alternatives. For example, we are seeing many more rounds that are structured in tranches. So you get to this result and we get you a part of the money, and then after 6 months you have another result and you get the other part of the money. Or there is a convertible note, so you don't set a valuation now, but you leave the valuation for a future moment in time. You can consider an extension as well. So if you've raised in the past 12 months, you might consider to raise an additional 1, 2, 3 million at the same valuation just to extend the runway. So to recap, I would say take the correct time and proper time to do the fundraising. So prepare in advance and then dedicate up to 3-6 months to it probably, and be creative on solution as well.
I would like to add to what Virginia said, that it's super important at these times, even though you're not fundraising, if you can start building relationships with, the next funds that are the ones that would fund your venture. Because this is interesting, and what Virginia said about last year is crazy, that deals were closed in 5-7 days. And here you're building relationships, and when you take a fund to invest in your company, these guys are gonna be with you for at least 8, 6, I don't know, maybe 10 years. So it's important for you to start building relationships super early on, so that when you are going out to fundraise, you already know the right people at the right funds, and you can start, talking about the important things without having to know each other before.
And do we think, it's obviously a tough time for a lot of people, but do we think that this is actually, there are some positives in that perhaps deals are being made with a bit more consideration, and that, perhaps the better relationships are coming out of this scenario?
Yeah, totally agree. So we think that right now, when you have relationships with the VC and the founder, it's like marriage. So you could not go into the marriage after one dating, right? So from one side, but from another side, also the current situations also help to hire great entrepreneurs and great talent. Because more and more executives from the corporates, their options are under the water, and they're wishing to build something new or go to work to startup. And also the lower valuations also helps to hire better people because they see more potential in the growth, in the future of growth. Because one of the reasons why Klarna decided to go for the down round, because they were having some troubles with the hiring new employees and paying them with the options with a very high strike price.
Yeah. So, oh, sorry, Josep, come in.
No, I think in line to what my colleagues are saying, I mean, on the current times is when you build probably better business, better relationships, things done on a rush. I don't think anyone can know each other with 10, 15 days rushing and trying to do due diligence that everyone understands that it's not thorough. The current times, we take as long as necessary. We take as long as necessary to get to know, to find the resources, to find the time to deep dive into what the company will need. And the relationships are built with this time of getting to know each other. The current market paralysis in certain stages, but as well in certain sectors, provides great opportunities for the very solid businesses. And we believe that this vintage is going to be an extraordinary one because they're amazing founders, they're amazing opportunities, and people that have the capacity to adjust and really tailor the business to the opportunity and taking tough decisions. Riding a bull market is very easy. More a whippy market is more difficult. But I believe that this vintage is going to be extraordinary one because the companies are going to come out. The ones that are going to be coming out alive, they're going to be stronger, and hopefully those are going to be.
Yeah, well, I suppose when we look at cycles, you can look at the companies that came out of the last major downturn, and you look at companies like Airbnb, like huge success stories that came out of very tough times. And I suppose you touched on talent, Vlad, and I suppose one element of there being layoffs at bigger scale-ups is that then talent becomes available for other companies. So that's one upside. And we've got just a couple of minutes left, but I want to talk about other potential upsides for Southern European, Spanish founders. Virginia, what do you think you focus on this market for Eightroads? Founders here are known for being able to be a bit more capital efficient. What kinds of advantages are there for Southern European businesses right now?
Yeah. Focusing on Southern Europe, I cover a lot in Spain, Portugal, and Italy as well, and I can compare also to what I see in other countries like France, UK, etc. And it's interesting to see that now everybody talks about you need to grow it in an efficient way, you need to have an efficient growth, etc. And it's much easier, at least from our side, find companies based in Spain that have an efficient growth compared to other countries. And that is probably similar to Italy as well. So up to 5, 6, 10 years ago, there was probably a limited amount of capital. So the startup had the need to become efficient in a faster way. And there is still the same dynamic. And then on top, I think in Southern Europe in general has a more attractive lifestyle as well. In post-COVID, in a context where to be an employer, you need to be different from the others. You need to have a more even holistic approach. The possibility of offering, remote working from where you want is also interesting, especially for attracting more talent in the Southern European market.
Yeah, certainly. I think, the opening up of that global talent marketplace has a lot of advantages for places like this where people want to move, I suppose, right? So we have come to the end of our time. Thank you so much, Jordi, Virginia, Josep, and Vlad, for all those insights and for bringing really tangible examples to the conversation. So big hand for our panelists, guys. Thanks very much.